From New York City, for our viewers worldwide, I'm Manus Cranny, in for Jonathan Farrow. Just looking at these markets, smelling the 5,000 line. You've got a whole new world for Disney, and you've got tech on fire with Arm. But we are prevaricating at the 5,000 mark. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up in the show, futures fluctuate. The rally that drove the market to fresh all-time highs. The bond market faces its next big test, another auction. And Arm and Disney impress investors. We begin with the big issue. The Fed preaching, you got it, patience.
You have to acknowledge how good the inflation data has been for the last 7 months. I mean, last 7 months, core inflation 1.9%. That's right on target. That's terrific, right? And I'm not rooting against inflation, but I'm always, trust but verify, let's make sure that's really right. And so we'll get a few more months. It would be, I would very much like to see that trend continue and, broaden.
It's about the breadth of the good news. Joining me now to discuss the Fed and more on markets, it is Morgan Stanley's Vishy Tripatur and Mona Mahajan at Edward Jones. Mona, I mean, it's tantalizing, isn't it? 5,000 on the S&P 500. We are on fire. Risk is on fire. Can we live long and prosper without 5 rate cuts as far as risk in equity markets is concerned? Good morning.
Good morning. And yeah, it's a great question. Look, we've looked at what happens when January is higher. There's that old saying in the markets, so goes January, as goes the year. And so January was up about 2% in the S&P 500. When we look back since 1950 years, there's been 44 years when January has been higher. 39 of those have been followed by a positive full year return and positive by an average about 18%. So while history may not repeat itself, we certainly have a precedent for January leading the market for a full year gain. Now, all that being said, we're looking at the fundamental backdrop, probably more so. And this year we are facing an environment where the Fed will likely pivot to rate cuts. We are seeing inflation continuing to moderate. And by the way, we have an economy that's holding up pretty nicely. So we think those combinations combined could lead us in a better direction. Now, keep in mind, we have had a very strong move, 22% higher since that October 27th low in the S&P 500. Could we be due for a period of consolidation or pullback? Yes, absolutely. But we think that the Fed is likely to cut rates probably in that 3 to 4 time range, or 3 to 4 cuts range that they have been telling us, and that we think could lead to better outcomes ahead.
Okay, still in there for the 3 to 4 rate cuts. Vishy, good morning, good to see you. We'll talk more about Barkin and the Fed in just a moment. But if I look at the bond market, 414 is where we are on 10s. The truck has been backed up ever so slightly. So my question to you is, we've shown up to buy paper this week in 3s and 10s. Does that continue for 30s today?
I would expect that. I think if you look ahead, we expect to see 4 rate cuts of 25 basis points each starting in June over the course of this year. And we think both from a technical perspective and a fundamental perspective, this sets up the duration to be in a really good place. So we would be constructive on duration going forward. I don't want to get too caught up in a sort of the day-to-day, week-to-week changes in the level of rates. But I think the underlying conditions are that we are looking at a Fed that is going to be easing policy, cutting rates, not only in 2024, we expect more cuts to happen in 2025. So on the back of that, we think that the outlook for duration is pretty solid.
You're beginning to sound like the Federal Reserve there in terms of not getting caught up in the minutiae of the day-to-day. But we can, of course, dig into the day-to-day. The Richmond Fed President, Tom Barkin, sat down and spoke to the team. Mike McKee led the conversation on this growing chorus of officials tempering our hopes for rate cuts. Mike, good morning. Good to see you. Great conversation with him. He just didn't take the bait on a couple of occasions. He likes the narrative on inflation, but it's got to broaden for him, doesn't it?
It has to broaden out. He does agree that they have met their mandate estimate on employment. And you look at jobless claims this morning at 218,000, lower than anticipated, going in the opposite direction of last week's big jump in jobless claims. He says that the labor market is in very good shape. And what Tom Barkin has noticed from the CEOs in his district is that people are slowing their hiring plans, but they are not letting people go. It was so hard to find workers that right now companies want to hold on to people. And the layoff notices we're seeing basically are a trimming of overhead, not of production kind of workers. So as you mentioned, put him in the camp with the others that we've heard from over the past week. 9 Fed officials, hadn't even been a week, basically. 9 Fed officials, all of them saying later this year, basically pouring cold water on the idea of a March rate cut. And even May is iffy at this point. They all want to see, as Barkin said, inflation coming down and the disinflationary effects broadening. Now, there was a warning for the Fed in yesterday's testimony by Janet Yellen up on Capitol Hill, the Treasury Secretary. She's going back up there today. She told people yesterday commercial real estate is an area we've long been aware could create financial stability risks or losses in the banking system, and this is something that requires careful supervisory attention. Tom Barkin endorsed that latter part, the supervisory attention, saying it's not something you necessarily want to cut rates over. But he did say we will see continued problems, continued losses in commercial real estate, particularly for offices, but it should be a manageable problem and that they are on top of it and they're working hard with the banks to make sure there's no systemic issues.
I like the phrasing that he used. Instead of losing a bank or two or a bank or two going under, he said a bank or two may be wrong-footed, but of course it depends the scale of the wrong footing. I've tripped a few times in my life, and some of them can be pretty bumpy crashes. Mike, thank you very much. Mike McKee with the Richmond Fed. Mr. Barkin, Vishy Patur and Mona Mahajan are my guests this morning. Vishy, let me take it to you. It's interesting. Barkin talks about reminiscing 1986. Inflation was 2%. 87, inflation doubled. The Fed had to hike rates. This is the ghost. This is the ghost that haunts them, isn't it?
Yeah, indeed. I think the way we would look at it is, how much of, we have clear evidence that the clear evidence of deceleration in the pace of inflation. So on the face of that, on the back of that, if you look at how much of restrictive monetary policy, how much of restriction is required in the economy, and if the Fed doesn't do anything, it just stands pat where they are, we are adding more restriction to the economy, and how much of that is required, and for how long. I think that's the crucial judgment that the policymakers will have to make. And we think that the extent of the restriction that is required would no longer be needed. We think that timing would be around the June timeframe, and there was some risk of a May. But we think really our base case remains June. We think the real question is how long the economy needs to be run at this increasingly restrictive monetary policy. And our response to that is that it doesn't. Therefore, the motivation for the Fed is not really to stimulate the economy, but simply to move back the monetary policy into a more normalized monetary policy.
So, Mona, more normalized monetary policy, you say the sweet spot is 3 cuts at 4. In a sweet spot environment, where do I want to be most exposed in the equity market?
Yeah, it's a good question. And, just to broaden that Fed conversation out, if they do 5 to 6 like the market expects or more, we could be in an environment where the economy is moving more south than we would like, and that's why they need to cut more. If they went 2, 1, or 0, it could mean that inflation. Are you seeing any
flashing lights that concern you about that? I looked at delinquencies yesterday. I look at some other credit card. I look at the amount of leverage in the system. The savings are dropping off. I mean, if you put them all together as a concertina, there are some amber lights.
Yeah, I think there is a case to be made that the economy could slow from a very high pace of gains. We've seen 4.9% in Q3 and 3.3% annualized GDP growth in Q4. That is above trend growth. Could we slow to what we're calling sub-trend growth of 1.5% to 2%? Yes, but we're not yet seeing the signs of any sort of downturn or negative growth in the economy. So we think a period of sub-trend growth could be likely, but by the back half of this year, given rates may be lower, inflation we think continues to moderate, we could see better trends ahead. And so to your point on where do we invest in that environment, well, we do think there is a broadening of leadership that probably plays out in the next 12 months or so. Last year was very much the year of the Magnificent Seven, the mega cap tech trade, and the year of cash and CDs. We think this year we see, you don't want to wholesale give up on the AI trade. It isn't a long-term secular bull market, but you want to complement that with parts of the market, the S&P 493, as we like to say, but cyclical parts of the market, even across the cap space. Think about the mid-cap space, which could play some catch-up. And then to Vishy's point, investment-grade bonds, continue to remain attractive here. Not only can you lock in some of those better rates for longer, given the longer duration, but the potential for price appreciation is still there, we think. So balanced portfolios, we think, will be the theme this year versus very concentrated, narrow portfolios of 2023.
Yeah, I mean, there were certain just real sort of hooks to hang our hats on last year. Vishy, you also would say that the Fed will cut the pace of QT. Now, can you co-join that pace of cutting QT with rate cuts? Do they jar against one another, I suppose, is what the market will ask?
So we think it's the pace, what we'll call taper. We think that the likelihood that the tapering of the QT, the quantitative tightening, will begin to happen sooner than what might be what we thought some time ago and what might be in the market expectation. The taper it would mean I think the idea of an earlier start to taper is to be proactively manage any potential challenges that come in the funding markets. So we think a taper is probably going to happen, an early start of taper going to happen. And a taper doesn't necessarily mean end of QT. So a taper, actually, an early start to taper could actually mean the quantitative tightening, the balance sheet coming down could actually go longer, but happens much more orderly to prevent challenges propping up in the funding markets. So we think that the QT will end. Our base case remains that it will end sometime in early 2025. But this moving the taper forward, we think will help mitigate, at least address some of the potential challenges that could be there in the funding markets.
From your side, Mona, what does a shift in QT mean?
Yeah, look, when the Fed was, Treasury was bringing a lot of Treasury bonds to auction in 2023, in fact, over $3 trillion worth. And there was a concern that the demand side wouldn't be there. And of course, that was because the Fed was no longer a key player in the market. They were implementing a very strict QT. We saw foreign economies, maybe there was a thought that China was not buying as much Treasury, although we saw an offset by the rest of the world. Mm-hmm. Keep in mind, even at 5%, a U.S. Treasury to the rest of the globe looks pretty attractive. But as we think about the environment moving forward, that $3 trillion of Treasury auctions only going to move higher. So you need the demand side of the equation to be there. The supply side is going higher. And so if the Fed does taper its QT, as Vishy suggests, we think that means that the Fed is now at least somewhat in the market, a buyer of Treasury bonds. Once again, that puts a little bit less pressure, upward pressure on Treasury yields overall. And that's really the goal of what they're trying to achieve here. They want to get gradually towards a more neutral level of Treasury yields of a Fed funds rate. And I think the combination of lowering the Fed funds rate gradually plus eliminating QT gradually over time as well puts that downward pressure on yields and gives us really a better balance in the Treasury bond market overall.
And that lowering of rates here in the United States, Vishy, just to talk about beyond borders for a moment, you are tempted towards emerging market debt. Any region in particular?
I think the opportunity set is somewhat better. Still remains the U.S. over the rest of the world. That remains the case. But I think there are pockets of higher quality emerging markets. The investment grade part of the emerging market is what we will find the sovereign credit risk to be more attractive. So we'll still, even within the emerging market world, we will lean towards the higher quality end of that.
Okay, that is a fairly complete conversation on these markets. Let's see, I thought Barkin really did hang on to the 1986 redux and the risk to 87. Vishy Tripatur and Mona Mahajan, thank you very much for being with us. Let's look under the hood ahead of the opening bell. Katie Greifeld is with me. Katie, what have we got?
Let's start with PayPal because it is plunging pre-market. Of course, it reported and it issued a disappointing 2024 outlook, which Wells Fargo said would, quote, vindicate the perma bears. Certainly seeing some vindication this morning. You have Disney, though, dominating. First quarter earnings beat expectations, gave a full year profit forecast that was seen as strong. The international parks business as well also showing strength. It also boosted its cash dividend by 50%, said it's targeting $3 billion in buybacks this year. That's good for 8% pre-market, and we have to talk about ARM. It is absolutely soaring. The chip designer, it beat mightily. It also gave a bullish outlook. This company has been pushing beyond smartphones, and that's paying off. The stock is up almost 27% pre-market.
Okay, Katie, thank you very much. That is quite literally ripping higher. Breaking news in the past 20 minutes. Saudi Arabia is said to tap Goldman and Citi for, you got it, an Aramco share sell. Get ready. That conversation coming up on Bloomberg. A bit of breaking news from Saudi Arabia. They're set to hire Citigroup, Goldman Sachs and HSBC for a secondary share sale in the oil giant Aramco. Take your mind back. Of course, they are now set to raise $20 billion in what could be one of the biggest offerings in the IPO market recently. Matthew Martin is with me in Saudi Arabia, staying late to break this news. Well done with you and the team on this Bloomberg scoop. Put it in context. They raised $30 billion a couple of years ago. It was all about the dividend. Here we go, $20 on the line. Are we going to be queuing up to buy this, Matthew? Give me the details.
Yeah, look, as you say, this is a follow-on transaction from that offering in 2019, which was the world's biggest IPO, raising around $30 billion. Since then, the government still holds a 90% stake in Aramco. There's another big 8% stake held by the Sovereign Wealth Fund. The government said it's going to reduce that stake as it looks to raise money to fund this huge economic transformation that it's been embarking on, and fund plowing all these money into all these sports deals and into all this investment that's going on around the world and domestically as well. So now it seems like we're very, very close to the government pulling the trigger on a second offering. It's got the banks involved now. It's got Goldman, as you say, Goldman, Citi and HSBC lined up for a secondary offering. We expect that they will, if they do decide to go ahead with an offering very soon, then there will probably be more banks added onto this.
Tell me how hard.
Remember from 2009.
Yep. Tell me this. To get this away, Matthew, in a post-COP28 environment, Saudi Arabia has just reduced the amount of production target for themselves. So this is about monetizing the asset, I presume. But are people going to be queuing up? Is this going to be such a massive coverage? The world is different to when it was first IPO'd.
Yeah, exactly. Even in 2019, it was difficult. It was a tough sell in a world increasingly worried about ESG, and also looking at Aramco as not being as having the high returns that you get from some of the other oil majors around the world. Now, what they've been trying to do since then is they've been trying to address this. They are there's a new mechanism so that they can pay out higher amounts of cash flow to shareholders in the future. Okay. They're investing a lot into going into other areas downstream, investing into renewables, investing into hydrogen to try and say that this is not just entirely an oil play. The thing is as well, the challenge in that story is, of course, that there's still 9 million barrels a day pumped of oil. It's still the biggest single producer in the world. So the majority of the Aramco story is going to continue to be crude oil production for a long period of time, even as they try and shift that narrative. And the other challenge facing them is going to be that in 2019, I mean, every investor under the sun was called and offered Aramco, and a lot of people decided not to take it then. The question is going to be, given a second chance, what are they going to say? Are they going to want to go for it now if they didn't go for it in 2019?
Well, perhaps we get the chance to ask Ahmed Nasser himself in Miami in a couple of weeks' time. So your job now, very clear, just get us an interview with Ahmed Nasser. I'll be there. You can get the flight Get the air miles. Matthew Martin in Riyadh, staying late, breaking the news with the Bloomberg team on Aramco. There is one other company this morning that is the talk of Silicon Valley. Arm, semiconductor surging, delivering a bullish forecast, showing its push beyond smartphones is helping fuel growth. CEO Rene Haas says, quote, "We are involved in just about every single end market, and just about every single market is putting more compute into their devices." Katie Greifield sums it up short and sweet. Good morning, Katie.
Yeah, you look at ARM right now, it's absolutely flying. To get into the numbers here, the chip designer said yesterday that revenue in the 3 months ending in March will be between $850 to $900 million. Analysts were looking for $778 million, so that is a huge beat there. The company also said that earnings will be roughly 30 cents versus expectations of 21 cents. And that rosy outlook really suggests, to your point, that ARM's expansion into new markets is bearing fruit. The chip designer has been pushing beyond smartphones. Those account for about a third of the company's sales, and we're looking into areas such as server chips. And if you take a look at their customer list, it really spans the entire tech industry. We're talking about Apple, Amazon, Qualcomm. They all use ARM's designs in some capacity here, and that diversification really paying off in shares this morning. You can see shares currently up about 27.5%. If that holds, it'll be the biggest one-day gain since its IPO.
You know what I'm praying is that there's a bit more ARM in that ESG portfolio that they've got for me than Tesla. Katie, thank you very much. Katie Greifield there with the very latest on the tech moves. And be sure to tune into Bloomberg Technology today, 11 a.m. Eastern Time. The ARM CEO, Rene Haas, will be with the team. Now, it's important. Day 2 of testimony. This is a live shot of the U.S. Treasury Secretary Janet Yellen. She is testifying at the Senate Banking Committee Financial Stability Oversight. Now, in her prepared testimony, she talks about what they're doing to maintain confidence in the banking system.
Cybersecurity information, including through ongoing partnerships between state and federal agencies and the private sector. Fourth, the Council is closely monitoring the increasing use of artificial intelligence in financial services, which brings potential benefits such as reducing costs and improving efficiencies.
What can we punch out today? We managed to deliver 2 record all-time highs on both NASDAQ futures and the S&P 500. This is a big psychological blockbuster for the market. We have 10-year paper being gorged on yesterday. Will they turn up in size for the 30-year auction today? There we go, NASDAQ 17,823. Let me get you up to date with some of your morning calls. This is what we've got. First up, Barclays upgrades Roblox to equal weight. PT, $46. Company has robust fourth quarter earnings. Next up, Wedbush downgrades GoPro to neutral. The price target there, $2. The analyst saying margin expansion opportunities are limited. And finally, Needham upgrading Disney to a buy. I love this. A whole new world under Bob Iger, expecting earnings growth driven by the company's streaming business. There is a world. Coming up, John Stoltzfus joins me very shortly ahead of the opening bell. Dogs to the nicety. This is a pet adoption company. There you go. I love it. I love it. They're always clapping more at the NASDAQ. Why wouldn't you? These are new all-time record highs. Yes, you might have a bit of a dip of red on the blood on the screen this morning. 5,012. 5,000. We haven't seen that level before. It's a big psychological level to break through and sustain the momentum on the upside. You're clearing through this earnings season. Is it robust enough to take you higher? There is the opening bell. Let me roll it over. By the way, you've got a difference between Walt Disney and, of course, ARM. Tech and consumer enjoyment are the bulwarks of this market. Euro dips by 1/8 of 1%. The dollar remains king dollar in a strong economy. 10-year yield 4.14. 30-year bond auction coming down the pike this evening. Will they turn up in size to buy it? And crude is up by 1.67%. Why? Why is crude taking a buy? We're up over 3% in the past 3 sessions. It's the longest winning streak since September. Soft landing, strong economy, take your choice, but they're not worried about geopolitics just at the moment. Disney, one line, Bob Iger, he delivers. That is the most important thing in this media company, giving a strong profit forecast, cost control, performance of the parks overseas. Katie Greifield takes me to a whole new world.
Lights out report for Disney, like you said. Let's go through some of the numbers right now because earnings rose to $1.22 per share. Analysts had been looking for 99 cents, so a big beat there. Revenue was a little changed. They did have some misses at the box office, but the profit outlook was quite strong. Disney said that thanks to cost cutting, profit will rise at least 20%. So there you have it. And let's talk about streaming as well. Of course, a lot of focus on the streaming business. Company did say that subscribers to Disney Plus, they did fall to 149.6 million in the quarter. Analysts had been looking for 151.2 million, but Disney also said that it expects to add as many as 6 million subscribers this period. And importantly, losses, they shrank to $216 million. For context, we were talking about losses of more than $1 billion a year ago. And the company also said that it predicts that its streaming operation will reach profitability by the fourth quarter of this year. Of course, there's a lot of focus on that date. They're well on their way there. And also some news from last night, Disney announced it's buying a $1.5 billion stake in Epic Games. And we should probably mention that international parks saw sales increase 35%. So you add it all up, and it was a strong showing from the House of Mouse.
Indeed, the House of Mice. I love it, Katie. Katie Greifeld there with the very latest on the House of Mice. Turn to fintech. PayPal forecasts little profit growth this year and says it continues to cut costs. Isabel Lee has the story. Down 7.82%. Isabel.
It's down 7.8%, Manus. And earlier in pre-market trading, it was down more than 9%. And when the market opened, down 10%. That's on track for its worst day since August. Investors are really spooked by PayPal's disappointing 2024 outlook. PayPal said it expects earnings to be flat this year. It announced last month it will cut its workforce by around 9%. The company blames its streamlining operations and its cost cutting as part of the measures it will impose. Its CEO in November said that PayPal's slow progress is really because of its cost-based and complex structure. But fourth quarter revenue and earnings, though, Manus, beat expectations. Volume climbed 15%, beating analyst expectations. We also have adjusted earnings, topping forecasts. And for 2024, the company also expects adjusted earnings of $5.10, which is unchanged from their previous estimate. Wells Fargo said this will vindicate the perma bears, but most analysts are questioning whether PayPal's big transition plans will translate into an actual growth. And here's also something interesting. PayPal said it will drop issuing annual revenue guidance and instead will do a quarterly one. Its CFO said, "We are just doing too many things, Manus." Shares now are down almost 8%.
Yeah, the perennial argument against the quarterly reporting. Isabel, thank you very much. Let's turn our attention to the chips market. ARM giving a surprisingly bullish forecast. Expanding beyond smartphones, Ed Ludlow is in San Francisco. It's a blistering performance by ARM, up 33%. This is AI writ large, isn't it?
It's AI writ large, and those gains accelerating out of the open. It is the biggest jump on the stock since they listed in mid-September. They're easily breaking through to fresh record highs. But you're right about the story. The numbers speak for themselves, right, in terms of forecasting sales of 850 million to 900 million this year, way above the street estimate of 778 million. The story is that ARM offers two separate services. One is the blueprint or building blocks for chip design, of which it charges on a royalty basis. The other side is that it offers the code that allows a semiconductor to communicate with the software that runs through it on a licensing basis. And what they showed us was evidence that they have moved away from smartphone in both cases. Smartphone is the history of their business. It's now just 1/3 of revenue. On the building blocks blueprint side, the latest iteration of their technology is V9. That carries double the royalty that prior generations of those chip blueprints used to carry. There's evidence that they're selling those and more cores to non-smartphone design centers, for example, what Microsoft is doing in server chips. I'd also point our Bloomberg audience to the terminal and online for the reporting about SoftBank overnight. SoftBank still owns 90% of ARM, even since the listing. And it recorded its first profit in 4 quarters overnight. But the narrative was very much, ARM is our big bet. It is our baby, and what we're going to do is position ARM as our main AI play. So when I speak to Rene Ass, the ARM CEO, in a couple of hours' time, I guess that's the question. That you have a parent company, to all intents and purposes, that sees you as its crown jewel and wants to be calling the shots. What do you think they'll do as part of that strategy?
Yep, well, it depends how much independence he wants in terms of thought process and strategy. Ed, good luck with the interview. We look forward to it. I'm sure we will listen to it acutely. Rennie Haas, the CEO of Arm, joining Ed and the team at 11 a.m. Eastern. Let's pivot to airlines. Spirit is fighting to preserve its acquisition of JetBlue. Reported a smaller fourth quarter loss than was expected. Natalia Knežević joins me with the very latest. So today is about the numbers for Spirit, isn't it, Natalia?
That's right. Numbers and guidance, of course. The stock is up by 4%. Adjusted loss was $1.36. It was better than analysts expected. Expectations was for $1.41 a share. Revenue came in line with expectations, and the company said that capacity for this year will be flat. But numbers for the last quarter were mostly given, and of course, guidance was the most important. Guidance was positive, or in this case, I should say, less negative than some people had expected. Well, first of all, Spirit expects an operating loss of $171 million. Expectations were for $200 million loss. And maybe the most important part here is that it expects a positive operating cash flow in the second quarter and throughout this year. However, Citi analysts are saying, we know that Spirit has debt that matures, $1.1 billion debt that matures in 2025. And there is a very low visibility between this debt obligations and cash flow in 2024 and 2025. And of course, finally, we know that Spirit is trying to get this deal done with JetBlue, and the next key milestone is in June. That is when we will have hearing, and that is also when this offer from JetBlue will expire, Manus.
Okay, Natalia, thank you very much with the very latest on Spirit Airlines. A couple of breaking news headlines coming from the Treasury Secretary, who is on Capitol Hill today, Janet Yellen, as you can see in front of the panel. She says the U.S. needs to reduce its deficits to reach a sustainable path. There's no sign of issues with the Treasury's debt selling ability. We saw that this week. We saw this with the 10-year government bond auction this week at a record $42 billion. And in an extreme case, it's possible to see issues with selling debt, but not for the moment. That is the Senate Banking Committee that she is in front of at the moment. We'll keep an eye on that, because the debt, the trajectory of debt in the United States of America, the servicing of the debt in the United States of America is now a very incumbent issue in the medium term on debt. 30-year paper auction tonight. Let's see whether they chew on the words of Yellen. Let's return to some of the good news that we've had in the past 24 hours. We've got new all-time highs posted in the Nasdaq and the S&P 500. Now, while psychologically important, 5,000, that level, it may prove, well, how much of a hurdle will that prove? Markets have so far shrugged off the fears around commercial real estate to power ahead. We did some analysis at Bloomberg on the earnings calls, and they signal warnings on weak demand and a continuation of the AI frenzy. So the warnings of weak demand are dissipating. Let's see just how bullish he is. It is Oppenheimer's John Stoltzfus. He joins me now. So, John, those warnings of, ahead, they're dropping off. The AI word search is ramping higher. Big shout out and thanks to Danny Berger for flagging that to me. How robust is this earnings season in your mind? John, good morning.
Well, good morning, Manus, and thanks for having me on the show. I must say, it's rather than robust, I think it's the picture of overall resilient. 11 hikes into this Fed funds hike cycle with 5 pauses, and with the Fed showing remarkable success thus far without pushing the economy into a recession. Developments in technology are certainly helping, but if we look at the earnings on the EA page of the Bloomberg terminal, while you do have double-digit negative earnings in energy, materials, and healthcare, you have double-digit earnings growth and substantial in communications services, consumer discretionary, and information technology, and in utilities. How's that? So overall, I think companies are showing greater resilience, and I think that's showing up. I also believe we're seeing greater capitulation, broader capitulation within the bear community, although we always are aware that the bears will find any interest, any catalyst possible to sell and take profits without FOMO after the kind of lift we've seen in stocks.
What are the signs of capitulation that you're seeing? Just expand on that for me, John.
Yeah, well, the signs are two very prominent short sellers. I think within the last 3 or 4 months on Bloomberg News, it was reported that they had ceased operations because it was just too difficult. And likely the cost to carry margin is much more expensive now than it was during the free money period. So if you get it wrong, it hurts a lot more. And if you get it right, if you're a short seller, you don't make as much as you got to pay the big, so to speak. So when we look at it, it's the capitulation is also, we can't help but think, among some private investors who were just very nervous and were concerned. And then when they consider, particularly whether it is those preparing for retirement or in retirement, boomers who will likely live much longer than they ever expected, if you consider the difference between a 10-year at 4.2, 4.5% yield versus stocks that are when they are fundamentally sound, okay, the good ones, likely to deliver better returns over the course of a few years, people are broadening their diversification back into equities. And I think that's what you have going on here.
Yeah, it's a question of whether you deploy all in. Now, in 1986, I was studying economics. I didn't know much about the rate differentials then, but I listened to Barkin this morning from the Richmond Fed, and he's talking about 1986, and they don't want a rerun of that, John, which is where inflation was tamed, and the following year, it was certainly not vanquished, and they had to ramp rates again. When you listen to this cacophony of restraint from the Fed about cutting rates, what does that say to you about risk? Because risk is powering ahead without the Fed accepting that it's going to begin its rate cutting strategy anytime soon.
Well, I'd say, Manus, I started in this business in 1983, so I came in as Volcker was early in his second term as Fed chair. So, you know, I'm a student of the Fed action and the personalities that run it and the regimes that are created. And the Ben Bernanke legacy is the best that we've ever seen. And I think what's gone on is I think within the market, we saw towards the end of last year and at the beginning, the market was looking for, 5 to 6 cuts. To us, it looked like likely 2 cuts. We thought later rather than sooner. And it turns out it does appear that it's going to unfold that way. I think Jerome Powell wants to avoid in any way being Arthur Burns, and he doesn't want to have to take draconian action that Volcker had to take. And so likely they're going to be very careful before, and they're very clear, whether the market believes it or not, the Fed is being very clear in its communications that it does not want to cut rates and then have to go back and raise them. Our viewpoint now is the Fed will probably retain the pause long enough so when it cuts, it won't be cutting because we're in recession or about to go into recession, but instead they'll be saying enough is enough based on where the levels of inflation will be when they begin to cut. It'll just be the right time to do it. And this is an extraordinary thing, but we did see, at least on parallel in 1994 going into 95, some similar kind of stuff.
Tell me this. We have David Einhorn at Greenlight Capital. Just a quick response on this. He said passive investors have no opinion about value. They're going to assume everybody else has done the work for them. I mean, he says markets are fundamentally broken because of passive investors. When it comes to breadth, do you think breadth is a laggard just because of the headlines that growth has sucked out of the air?
Well, I think perhaps it has. I would say this. I think the passive investing that is brought about by the ETF crowd, which I think Einhorn was addressing, it depends when you look at it. A lot of ETF investing is strategic allocation, but is tactically weighted in portfolios, so moves around, and actually is a play on equities for investors who are either looking for a place marker while they select individual stocks, in the case of small, mid-sized institutions, even large institutions, and on the other hand, for individuals, if they don't have exactly enough money to diversify broadly with individual stocks, the ETFs give them that opportunity. So we don't agree with Einhorn here, though we certainly respect him as a well-known component within the market.
Okay, John, thank you very much. John Stoltzfus with his views on the market, and indeed a student of the Fed from the Volcker tonight, coming up on the show. A strong profit outlook. Disney prepares for a big step in the world of streaming.
The focus when you do a three-way JV is on how do we make sure that we get the operating principles right so that the parties are aligned up front and they're aligned ongoing in delivering a great product to consumers. And that's the real focus here is how do we make it easier and reduce friction for the sports fans?
A conversation coming up next on Bloomberg.
The focus when you do a three-way JV is on how do we make sure that we get the operating principles right so that the parties are aligned up front and they're aligned ongoing in delivering a great product to consumers. And that's the real focus here is how do we make it easier and reduce friction for the sports fans? We're really getting good traction and good momentum on managing our costs more tightly while reinvesting back in the business to drive the top line as well.
Disney delivering better than expected results, cost cutting, delivering the benefits. Strong performance in the international theme parks. The company also delivering an upbeat outlook for the year, ahead of expecting to turn a profit in the streaming business by the fall. Geetha Raghunathan joins me now, Bloomberg Intelligence. Geetha, we caught up a little bit earlier this morning. You've got to say, this is precision engineering in turnaround story by Iger.
Oh, absolutely, Manus. I mean, the magic is back, and it is back big time. So we had a whole host of positives that Iger delivered. Of course, you had all the financial metrics that came in well above estimates. You know, they have that guidance there, 20% EPS growth in fiscal 2024. That's 9% above consensus. And just kind of looking at all of the drivers that they put in place, right? All of these cost-cutting initiatives. You have a share buyback program. You have the streaming business kind of hitting profitability. And then you have the new initiatives, right, with the ESPN, the two bundles. One is the ESPN standalone. The other one, of course, is the combined product. I mean, they're really setting themselves up for strong EPS growth for many more years. So this is turning now into a profitability story and a capital return story.
It is, and if you look, of course, you know, he's joining in on this new evolution, this new iteration on streaming. It's pretty powerful trifecta. But you also make the point about ESPN having its own evolution apart from the new sports streaming service.
Yeah, so the ESPN standalone is going to be, I think, a little bit different from that sports super app, which is going to come a little bit later this year. The ESPN standalone service, which will come out in August of 2025, basically is going to integrate sports betting. It's going to have, you know, personalization, maybe some fantasy leagues, e-commerce, so all kinds of different features. But ultimately, Disney's play is really about the bundle. I mean, they have the best streaming bundle, Manus, out there on the market. They know that about 40 to 50% of their subs are actually taking the bundle. So this really resonates with customers. And you're absolutely right. I mean, this reduces friction, right? Customers at the end of the day want something that is simple, right? It's really simple to use. And the bundle does that for them. And taking ESPN over the top allows them to sell this comprehensive bundle. And they think it's going to work because it has so far.
I mean, I just switch on my own TV. I've got Amazon, I've got Apple TV, I've got Netflix, and you're flicking around on a constant basis. I wouldn't mind a one-stop shop on that. Geetha, thank you very much, Geetha, on the very latest with Disney. Well, for some more price action this morning, let's get back to Katie Greifeld in terms of the movers. Katie, what have we got?
Well, you take a look at what the sectors are doing right now. The S&P 500, it's below that 5,000 level, but the sectors, it's pretty much an even split. It's changing a little bit. You have 7 sectors in the green right now. We're led by energy. It feels like we haven't seen that in a while, up about 0.6%. Consumer discretionary and consumer staples also managing to stay in the green here. Then you take a look at what's not working. You do have 4 sectors underwater right now. That is materials, it's healthcare, it's utilities, and it's financials. Of course, a lot of focus on the financials, particularly those regional lenders, but you add it all together, though, and the sector as a whole is under pressure. We'll see how that story plays out, Manus.
Okay, Katie, thank you very much. Katie Greifeld there on the sectors. Coming up on the show, market moving events. Can we stay above the 5,000 level? Will we continue with the dizzying records that we are making in the United States of America? Oh, it's below 5,000. Let's see how the rest of the day goes. told you there were psychological barriers in this market. We're failing at the 5,000 level. NASDAQ continues higher again, record after record high. Robustness in the Russell 2000. Disney's on the pump, ARM's on the pump, higher as well. 30-year government bond yields are going to be at the bottom of your screen. We're waiting for that auction to hit the tape to this afternoon. 436 is where we trade. This is what you got to keep an eye on. More Fed speak if you haven't had enough. We've got the Fed president, Tom Barkin, the Richmond Fed. That is at noon Eastern. He's just been on Bloomberg. The 25 bucks of 30-year paper, 1 p.m. Eastern time. What is the tail? Will they turn up like they did for the 10s? PepsiCo earnings before the bell on Friday. And more Fed speak. Dallas Fed, Laurie Logan.